When we talk about investing, the most valuable commodity is not money, it's time. And right now, time is the one thing slipping through our fingers faster than ever before. The warning from Bank of America isn't just another financial headline meant to stir up attention. It's a reminder that the world we live in, economically, socially, and politically, is changing at a pace that most people still underestimate. And when things change at this speed, hesitation isn't neutral. It's costly. Think about this for a moment in markets. Every opportunity has a window. That window is wide when it first appears, but it narrows quickly as more people recognize it. By the time the average investor decides to act, that window is often already closing, sometimes even shut. That's why you hear stories about people who bought into Apple in the early 2000s or Tesla in the early 2010s and created massive wealth, while others who hesitated ended up chasing those stocks when the biggest gains had already been captured. The difference wasn't intelligence. It wasn't access. It was timing. Those who acted early multiplied their capital. Those who waited paid a premium to get in late, often with far less upside. Now, here's the deeper truth. Human beings are wired to hesitate. Psychologically, we prefer the comfort of certainty. We want confirmation before we move, validation that we're making the right decision. But in markets, certainty rarely exists in advance. By the time things look obvious, the opportunity has usually passed. That's why Warren Buffett says, be fearful when others are greedy and greedy when others are fearful, because by the time the herd feels safe, the reward is already gone. This is the urgency of now. Bank of America is essentially saying the conditions in the global economy, the interest rate environment, inflationary pressures, technological disruptions, they're not waiting for anyone to catch up. And the market will not send you an invitation in the mail saying, this is the perfect moment to invest. It moves forward relentlessly with or without you. What does this mean practically? It means that at every day you delay making a decision, whether that's reallocating your portfolio, moving into new sectors, or simply getting off the sidelines, is a day that compounds against you. Time compounds just like money. If you let fear or overthinking hold you back, you're not standing still. You're actually falling behind. The world is compounding forward while you stay in place. Now, I don't say this to provoke panic. Acting fast does not mean acting recklessly. There's a big difference between impulsive decisions and decisive ones. The key is preparation. If you have clarity on your goals, if you've studied the cycles of history, if you understand the principles of diversification and risk management, then when an opportunity presents itself, you don't freeze. You act because you've done the thinking in advance. You've built a system that allows you to move with speed and conviction. The investors who win big aren't the ones who never make mistakes. They're the ones who shorten the gap between recognizing an opportunity and moving on it. They accept that no decision comes with absolute certainty, but they also know that waiting for certainty is the surest way to miss out. So ask yourself right now, how much has hesitation cost you in the past? How many times did you wait for the perfect moment only to watch the opportunity slip into someone else's hands? And then ask yourself a tougher question: how much longer can you afford to keep repeating that same mistake? Because the truth is simple. Future doesn't wait. It punishes delay and rewards speed. And as Bank of America has made clear, is one of those moments in history where indecision is the most dangerous position of all. act now, or accept the cost of waiting. That is the choice in front of every investor today. One of the greatest illusions in investing is the belief that opportunities will always be there, waiting patiently for us to decide when we're ready. But markets don't work that way. Opportunities appear, they reward those who act, and then just as quickly, they disappear. It's like a train pulling into a station. If you hesitate too long on the platform, the doors close, and by the time you step forward, the train is already gone. History gives us countless reminders of this. Think back to the early 1980s, when interest rates were at record highs. Those who had the courage to invest in bonds during that time locked in returns that seemed extraordinary in hindsight, but that window didn't stay open. Within a few years, rates fell and the once-in-a-generation opportunity vanished. Or consider the aftermath of the 2008 financial crisis. The people who invested in equities when fear was at its peak, when the headlines were screaming collapse, captured some of the strongest gains of the decade. For those who waited until the recovery looked safe, most of the upside had already passed them by. This is the nature of markets. They move in cycles. They present chances that look uncertain in the moment, but obvious in hindsight, and those windows don't remain wide open for long. By the time the consensus forms, by the time everyone feels comfortable, the opportunity is already priced in. That's why we so often hear people say, if only I had invested back then. It's because they didn't recognize or act on the closing of the window. But this isn't just about financial history. It's about human psychology. The reason most people miss these windows isn't because they lack information. It's because they fall into the trap of waiting for clarity. They want perfect visibility before they move. The problem is that clarity usually arrives after the market has already adjusted. The uncertainty you feel in the present is the very reason the opportunity exists. If there were no uncertainty, there would be no reward. This is where philosophy meets investing. Life itself is a series of windows. They open, they close, and they rarely reopen in the same form. The job of an investor is not to chase certainty, but to develop the judgment and discipline to act while the window is still open. That means recognizing that hesitation has a cost, not just in lost profits, but in compounding missed chances that you can never fully recover. Bank of America's message is crystal clear. We are living in a moment when the windows are moving faster than usual. Technology is disrupting industries at a pace we've never seen before. Global shifts in interest rates, inflation, and geopolitics are reshaping entire markets in real time. If you think you can wait 5 or 10 years for things to settle, you'll wake up in a world where the landscape is entirely different and the doors you were hoping to step through no longer exist. And let's be honest, most people only realize a window has closed after it's too late. They see the rise of a stock, the boom in a sector, or the growth of a new technology, and they regret not having moved sooner. But regret doesn't create wealth, action does. The only way to avoid living in the shadow of missed opportunities is to condition yourself to recognize when the window is open and to move before the rest of the world catches on. So ask yourself, what opportunities are sitting in front of you right now that you're hesitating on? What doors are open today that may be closed tomorrow? Because in investing, as in life, the worst words you can ever say are, I'll wait until later. Later is usually too late. The window is open now. The question is, will you step through it or will you watch it close from the platform? When we think about risk, most people only see one side of the equation. They focus on the possibility of losing money if they act. That's the fear that paralyzes investors, the thought that if they make the wrong move, they'll regret it. But what's often ignored and what's just as important is the cost of inaction. Doing nothing feels safe, but in reality, it is one of the riskiest choices you can make because time itself is working against you. Consider inflation. Every year that you leave money idle, its value erodes. What you could buy with $100 last year, you may not be able to buy this year. And over a decade, that erosion compounds into a massive loss of purchasing power. You may not feel it on a daily basis, but it's happening quietly, relentlessly in the background. Inaction, in this sense, guarantees loss. Action, on the other hand, at least opens the possibility of gain. This is a fundamental principle in both life and investing. Standing still is not neutral. The world moves forward whether you do or not. Economies evolve, technologies disrupt, markets shift. If you choose not to adapt, not to engage, you don't preserve your position. You fall behind. And by the time you realize it, catching up is far more costly than having acted early. Think about the 2008 crisis again. People who pulled back completely, who sat in cash out of fear, may have felt safe in the short term. But when the recovery began, when markets started to surge, many of them stayed frozen, waiting for the perfect moment to re-enter. By the time they finally stepped back in, much of the upside had already passed. Their inaction didn't protect them. It cost them the very gains that would have rebuilt their wealth. Psychologically, we're hardwired to avoid loss more than we're motivated to pursue gain. That's called loss aversion, and it's one of the most powerful biases in human decision making. But here's the paradox: by letting fear dictate our choices, we end up ensuring the very outcome we're trying to avoid. We fear losing by acting, but in the process of waiting, we lose by default. That's why the cost of inaction is often greater than the risk of action. Now, doesn't mean acting recklessly or chasing every trend. It means making disciplined, thoughtful moves rather than retreating into paralysis. The investor who diversifies, who takes measured risks, who puts capital to work instead of letting it decay, is always better positioned than the one who hides in the illusion of safety. Safety without growth is just slow decline. Philosophically, this extends beyond money. Inaction in any area of life, whether in relationships, careers, or personal growth, creates regret. You might regret a decision you made that didn't work out, but you'll learn from it. Regret from inaction, though, is heavier because it lingers. It leaves you wondering what could have been. And in markets, that regret compounds, not just emotionally, but financially, as missed opportunities accumulate into real losses over time. So when Bank of America says, act before it's too late, they're not pushing people toward recklessness. They're pointing out a reality delay is its own form of risk. It's not a passive choice. It's an active decision to surrender wealth, growth, and opportunity to those who had the courage to move when you didn't. The truth is simple. The fear of losing by acting must be weighed against the certainty of losing by doing nothing. And when you see it through that lens, choice becomes clear. The market doesn't punish mistakes as harshly as it punishes hesitation. Action gives you a chance. Inaction guarantees decline. So remember this, it's not the risks you take that destroy you. It's the risks you avoid by refusing to act. When most people think about risk, They frame it in a very narrow way. They imagine risk only as the possibility of making a wrong move. They picture losing money, watching their portfolio shrink, or regretting a choice that didn't work out. That picture is vivid and it's powerful. It's what keeps so many investors frozen on the sidelines. But what rarely enters the conversation, and what's just as important, is the hidden cost of doing nothing. Doing nothing feels comfortable. It feels like the safer option, but comfort can be deceptive because while you're standing still, the world around you is moving. Inflation is quietly eroding the value of every dollar you hold. Markets are redistributing wealth to those who act, while those who wait are left behind. Opportunities don't simply sit. They're waiting for you to feel ready. They're seized by others and then they're gone. Inaction is not safety. Inaction is slow decay. Think about it this way. If you put your money in a drawer today and come back 10 years later, that money will buy less, not more. You didn't gamble. You didn't make a bad trade. You didn't lose in the traditional sense, but you lost all the same. You lost to time, to inflation, to the unstoppable forward movement of the economy. And that's the paradox. Doing nothing can feel like avoiding risk, but in reality, often guarantees loss. We saw this vividly during the 2009-2010 recovery. Investors who froze during the crisis, who convinced themselves they'd wait until things felt safe, sat out on one of the greatest bull markets of modern history. They avoided the risk of losing more in the short term, but in exchange, they missed the massive gains that defined the next decade. Inaction cost them far more than the risk of disciplined action would have. The deeper issue here isn't financial. It's psychological. Human beings are loss averse. Studies show we feel the pain of losing about twice as strongly as we feel the pleasure of winning. That bias makes us overestimate the risk of action and underestimate the risk of inaction. We fear the visible sting of a bad investment far more than we fear the invisible erosion of missed opportunity. But that bias doesn't change reality. It just distorts our perception of it. The most successful investors understand this. They don't eliminate risk because that's impossible, but they manage it intelligently. They diversify. They set rules. They accept small, calculated risks today to avoid catastrophic risks tomorrow. They recognize that refusing to move is itself a form of risk, and usually the most dangerous one, because the market doesn't stand still, and neither does time. And here's the philosophical layer. This isn't just about investing. It's about life. The moments you hesitate on, the projects you don't start, the calls you don't make, chances you don't take, those inactions have a cost too. You don't always see it immediately. Over time, it accumulates into regret. And regret from inaction is heavier than regret from mistakes. Mistakes at least carry lessons. Inaction leaves you with nothing but what ifs. So when Bank of America says investors must act before it's too late, they're not just pointing to market timing. They're pointing to a principle. The greatest threat to your future wealth is not the possibility of being wrong. When you act, it's the certainty of falling behind when you don't. The cost of inaction compounds silently, invisibly, but relentlessly. Every day you delay, you are paying that cost. And the longer you wait, the higher the price becomes. So remember this: action carries risk, yes, but inaction carries certainty. And certainty in this case means loss. The real danger isn't making a move and being wrong. The real danger is refusing to move at all. At this point, the question naturally becomes if acting fast is essential, then what kind of actions make sense? It's not just about speed, it's about strategy. Acting recklessly is no better than doing nothing. The key is to act with intention, to make moves that position you for resilience and growth, regardless of how uncertain the world feels. And here's the reality: the future is not predictable in detail, but it is predictable in patterns. Markets move in cycles. Economies expand and contract. Innovation disrupts old industries and creates new ones. Political forces shift the flow of capital. None of this is new. It's been happening for centuries. What matters is not guessing the exact outcome, but aligning your decisions with principles that work across cycles. That's how you navigate uncertainty with confidence. So, what should an investor do right now? First, think about diversification. Sounds simple, but most people misunderstand it. True diversification isn't just holding a handful of different stocks. It's spreading exposure across asset classes, sectors, and geographies so that no single shock can wipe you out. In a world where interest rates are shifting, currencies are volatile, and technological revolutions are reshaping the economy, diversification is no longer optional. It's survival. Second, identify the sectors where growth is inevitable, even if the path is volatile. Look at technology, artificial intelligence, clean energy, biotechnology. These are not passing fads, they are structural transformations. The companies and investors who align with these forces will ride the wave, while those who ignore them will be left behind. That doesn't mean chasing hype. It means studying the fundamentals, recognizing the direction of history, and placing thoughtful bets on the future. Third, don't ignore safe havens. In moments of uncertainty, investors need balance. Precious metals, defensive sectors, or even cash equivalents in the right proportions provide stability while you take calculated risks elsewhere. The goal is not to avoid risk, but to build a portfolio where risks offset each other, creating durability in the face of shocks. But there's another layer here beyond the mechanics of investing. Strategy is also about mindset. Most people think in straight lines. They assume that the future will look like the recent past. But cycles are nonlinear. Booms turn into busts. Fear turns into greed. The disciplined investor is the one who can step outside of the emotional noise, see the larger pattern, and make decisions accordingly. That requires not just financial knowledge, but psychological discipline. This is why preparation is so important. When opportunity shows up, it's already too late to start thinking. You have to prepare in advance, know your risk tolerance, clarify your goals, and build a framework for decision making. That way, when the window opens, you don't hesitate. You move with conviction because your preparation has already done the heavy lifting. And let's not forget the broader principle at play. Acting strategically today isn't only about maximizing profit, it's about protecting your future self. The choices you make now, even small ones, will compound over time into either security or vulnerability. The investor who says, "I'll get serious later," is building a foundation of sand. The one who says, "I'll take deliberate steps today," is building on rock. Bank of America's warning is not just to act, it's to act wisely, act with urgency, but also with clarity. This moment in history is not forgiving to those who cling to old models or delay for the illusion of certainty. It rewards those who adapt, diversify, and place their chips on the forces that are shaping the next decade. So the call is simple. Don't just act fast, act smart. Don't confuse motion with progress. Let your moves be grounded in principles, not panic. Because in a world of accelerating change, strategy is the bridge between urgency and success. The opportunity is here now. The only question is whether you'll move with purpose or let the future be decided for you. Up to this point, we've been talking about timing, windows of opportunity, and strategy. But even when all of that is clear, even when the logic is obvious, most people still don't act. And the reason isn't lack of knowledge, it's psychology. The biggest barrier to effective investing is not the market, not inflation, not even global crisis. It's fear. Fear is powerful. It's hardwired into us as a survival mechanism. Thousands of years ago, kept us alive by warning us of threats in the environment. But in today's financial world, that same instinct often works against us. When markets fall, fear tells us to sell. When volatility spikes, fear tells us to wait. And when everyone else is panicking, fear convinces us to follow the crowd. The irony is that fear, left unchecked, ensures we do the very opposite of what successful investing requires. Think about every major financial boom and bust. In the dot-com bubble, fear kept people from investing in technology companies before the world saw their true potential. And then greed, another psychological driver, pulled them in too late at the top. During the 2008 crisis, fear drove millions of investors to cash out at the very bottom, locking in losses instead of riding the recovery that followed. In each case, it wasn't a lack of opportunity. It was psychology that created failure. The truth is, fear is not going away. Can't eliminate it. But what you can do is train yourself to master it rather than let it master you. That begins with awareness, understanding that your emotions are not reliable guides in markets. What feels safe is often dangerous, and what feels dangerous is often where the greatest opportunities lie. That's why contrarian thinking, buying when others are fearful, selling when others are greedy, is so often effective. It's not magic. It's simply the discipline to resist being ruled by instinct. And discipline comes from principles. If you've thought carefully about your goals, your time horizon, your risk tolerance, and your diversification strategy, then you don't need to panic when volatility hits. You trust the framework you've built. You recognize that downturns are part of cycles, not permanent conditions. That perspective creates calm in moments where fear would otherwise overwhelm you. But there's also a philosophical dimension here. Fear thrives in the unknown. We imagine worst case scenarios because the future feels uncertain. Yet history teaches us that uncertainty is not new. Wars, recessions, political instability, these have always been part of the human story. And through each cycle, opportunities have existed for those who were willing to act with courage. The world has always rewarded resilience more than hesitation. This is why Bank of America's call to action is more than financial advice. It's a psychological challenge. They're saying, break free from the trap of waiting for certainty. It will never come. The investors who succeed are the ones who can sit with discomfort, who can move forward even when the outcome isn't guaranteed. And that mindset isn't just about money. It's a life principle. If you let fear dictate your choices, you'll avoid risk, but you'll also avoid growth. You'll live safely, but you won't live fully. Courage is not the absence of fear. It's the decision to move despite it. In investing, that decision is what separates those who watch opportunity pass from those who seize it. So the challenge is simple. Don't let fear write your future. Let discipline, principles, and perspective guide you instead. Because at the end of the day, Fear guarantees loss. Courage opens the door to possibility. The real question is, will you choose to be driven by fear, or will you train yourself to act with courage while others hesitate? We've walked through the urgency of time, the fleeting nature of opportunity, the hidden cost of inaction, the importance of strategy, and the psychology of fear. And all of it leads here to the choice that stands in front of you right now. Because all the principles in the world, all the strategies, all the insights, they mean nothing if they don't translate into action. The truth is, no one gets rewarded for what they know. They get rewarded for what they do. Knowledge is potential energy, but it only becomes powerful when it's applied. You can read the reports, study the data, even agree with everything I've just said. But if you walk away and change nothing, then the outcome is the same as if you had never listened at all. That's the danger of intellectual comfort. It tricks us into feeling like we've progressed when in fact we've done nothing. Bank of America's warning is not just a market note. It's a wake up call. They're saying the conditions of this moment are unique. The opportunities are real, but they are time sensitive. The world is shifting, and those shifts will create winners and losers. And here's the uncomfortable reality. Indecision is itself a decision. If you choose not to act, you are choosing your place among the losers. The market won't wait for you to feel ready. So what does it mean to seize the moment? It means stepping out of the illusion of safety and into the reality of progress. It means taking the principles we've discussed, diversification, preparation, courage, and putting them to work. Not next year, not when you feel ready. Now, because hesitation compounds and so does action. Every step you take today sets in motion a trajectory that will define your financial future years from now. But let's also look at this more broadly. This isn't only about investing. It's about how you approach life. Every great opportunity in your life, whether financial or personal, has come with uncertainty attached. And the people who thrive are not the ones who waited for guarantees. They're the ones who said, I don't know everything, but I know enough to move forward. They acted while others paused. And over time, those small moments of decisive action separated them from the crowd. There's a phrase I often come back to. The cost of waiting is invisible until it becomes irreversible. You don't see the opportunities you missed until they've already passed. You don't feel the erosion of inaction until the gap is too wide to close. And that's why this moment matters. The doors that are open right now will not stay open forever. The market rewards speed. The world rewards courage. And history only remembers those who were willing to act. So I'll leave you with this. Don't just listen. Don't just nod in agreement. Decide. Decide that you will not be paralyzed by fear. Decide that you will not wait for certainty. Decide that you will step into this moment with clarity and courage. Because in the end, it isn't the markets that determine your future. It's the choices you make in response to them. Act fast or lose big. That is the truth Bank of America is urging us to face, and is a truth we cannot afford to ignore. The time is now. The choice is yours.